everyone, and welcome to La Frontera, a podcast dedicated to exploring the dynamic startup and venture capital ecosystem in Latin America and the innovators behind it all. We're your hosts, Cyrus and Tom. If you enjoy this conversation, we invite you to subscribe to our newsletter where we announce new episodes and share additional insights and resources for founders and investors alike. We'd also like to invite you to share this podcast with your friends and to leave a review on Spotify, Apple, or YouTube to help more people discover the show. We love hearing from our audience. You can connect with us on LinkedIn and Twitter by searching for La Frontera Podcast. In our very first episode, we sit down with Cristobal Perdomo, co-founder of Wollef VC, to unpack what it takes to build and scale a top VC fund in Latin America. Cristobal shares how he raised his first fund, the key differences between LP bases in Mexico, the US, and Brazil, and why foreign investors need strong local partnerships to succeed in the region. We also dive into the challenges of exits in LatAm, the role of IPOs and M&A in creating liquidity, and whether it's still too early to truly judge the potential for long-term success of VC in the region.
All right, welcome back to another episode of La Frontera Podcast. Today, we're super excited to sit down with Cristobal Perdomo. He's a co-founder and GP of Wollef Ventures. Cristobal is a very savvy investor with a lot of experience, I think more than 10 years investing in startups in Latin America. So really excited to hear all the wisdom he has to impart upon us and our listeners. So thanks so much for being with us.
My pleasure. Thanks for having me.
Would love to get started with hearing about your personal and professional background, just understanding your, I guess, path to starting a VC firm all the way from before business school to Columbia Business School and then coming back to Latin America.
So I always knew I wanted to be an entrepreneur since I was a teenager. I think it was just movies, right? I saw movies and I saw entrepreneurs that were great and I thought I want to be that. Unfortunately, I decided to study law, which is the most entrepreneurial thing in the world. But I come from a very conservative family. They wanted me to have a regular career, and that was it. But throughout law school, I did a couple of enterprises. I did a video game company. I did a pharmaceutical company. I did a nightclub, and I enjoyed all of those. And at some point, I had to work at law because, when you're a lawyer, you need to sometimes practice. So I started working as a lawyer. I hated every second of it, and I couldn't see a way of getting out of it. And the only way I could think about it was getting an MBA. And in trying to think about getting an MBA, I went back to my idea of doing entrepreneurship. And this was the late 90s, right? So you had all these .coms in the US. You had all these publications about there wasn't really a lot of internet, but there was a lot of publications about the internet. Because I had these magazines about startups. And those magazines started talking about something called venture capital, which I didn't know anything about. And it was this very cool idea of getting other people's money to invest in very new ideas and entrepreneurs, right? Which had always been a problem when I had started my businesses. I always had a problem of getting money from people I knew. And thankfully, I knew people that had money, so that worked out. But at some point, I was being annoying, right? I was calling them for money. So this idea of being a completely unrelated party, having money to give people for starting the business, and that's why I was going to be interested in doing it, VC.
So looking at Wollef's portfolio, as incredibly impressive, especially for one in Latin America. You've invested in most of the region's top performers like Nubank, Kavak, Loft, Jeeves, to name a few, and then have stake in a lot of companies that are also very promising. Would love to hear about what do you think in your past before starting Wollef has contributed to you being a successful investor? Obviously, having entrepreneurial ventures and kind of understanding, I guess, like the play of the founder might play a part, but would love to hear your perspective.
So I sort of forgot about being a venture capitalist because when during business school, I could never find a job as a VC. So I sort of thought that's something that happens to other people, not for me. But then I moved to Argentina in 2008. And Argentina is a very entrepreneurial country, more out of necessity than out of will, right? There's a lot of great jobs, but there's a lot of opportunity. So I started doing a startup there, and I started to have a lot of contact with these VCs. And that sort of reminded me of me liking that thing. But I also learned a lot of things that I hate about VCs, right? And basically, the idea to do venture capital for us creating Wollef was we want to do a very entrepreneur-centered firm, I wanted to not do anything of things we didn't like, right? VCs are super hierarchical, and you sort of have to go through all the layers to get to the top people, decision makers, right? So you have to speak with the analyst, then repeat the same thing to the principal, then somewhere along the way, magically a partner will appear and say, no, thank you. But there's so much wasting time. And when it would have been easy no in the first interaction, it would have been fine, right? But so one thing we centered in was be as direct as possible, waste as little time as possible when you have entrepreneurs. That was one thing. Another thing was be as direct as we could in our feedback. Also, one thing I hated about VCs was that they always gave you these fluffy answers about why they were not investing, right? Like, oh, is that right for us? What does that mean? Or it's not a focus for us, whatever the hell it is. So we said we want to do a lot better than that. And if we're not going to invest, at least the best thing we can do is give precise feedback. So that's another thing. And the other part why we wanted to do this, so those are the negatives that we tried to get out. The positives was we really liked interacting with entrepreneurs. My partner and I, we both had to spend a lot of time in corporate world. And the corporate world is filled with people that hate their jobs. And when you talk to entrepreneurs, the greatest thing is that everybody's super excited about what they're doing. They're super positive about what they could accomplish. Most of them don't, right? But they have that intention, right? And they have that energy. And that's something that we really like. And we thought that there were a lot of things we had to learn along the way about how not to build a company that would be very helpful. I don't know if we knew enough about how to build one, but we knew how about what not to do to build one. Right? So that's why we set to the term.
Yeah, which is sometimes just as important and as knowing how to build a successful company. But yeah, I definitely a lot of that resonates with me. Is one of the reasons I've been interested in VC as well. Yeah, and would love to hear with Wollef. You talked about the specific things that you guys like to do differently from other VCs. What's makes you successful? What's kind of your overarching investment thesis? And for Latin America, like how has that kind of evolved over time over the past 5-10 years?
So everybody laughs when we say that we invest in companies that make a lot of money. That's our main goal. That's our whole thesis. Besides that, and that's important to say that because we start off with the idea that we don't know nothing about the market, right, or the future. So there's no way for us to pick winners. We know that. But I think we're pretty good at analyzing businesses from the bottom up. So we look at a business that if the business is making money, I mean, they have great margins, we like it. If the business is growing very fast, we like that. Right? If the business has stickiness with our customers, we like that. So those are the general things we look at when we look at a business idea. We don't care about whether it is education, health, financial services, whatever it is. As long as it has that, then we'll dig in. So we start from an idea of ignorance and try to work our way into something that we think can be really interesting.
So what are you looking to invest in going forward?
I have no idea. No, I really like I said, I would never have thought we were investing in a MVNO, right? We just invested in MVNO. I would never have thought we were going to be investing in a cafeteria chain. We just did that. Right?
Yeah.
So I don't know about the future. I think we have very set idea of what we don't invest in. So, or it's very difficult for us to invest. So we didn't do anything science related. We have no idea about science. So we don't know why one technology should vanquish another. We don't invest in anything related to hardware. We don't know anything about manufacturing. So there's no point for us doing that. We don't invest in anything related to crypto. We don't understand crypto. There's no point for us doing crypto investments. We do have investors that use crypto, right? But none of that's the main thing. We don't invest in advertising. We did that in the past, advertising technology. We learned that they're great companies for founders, not for investors. The outcomes are really pretty small. And the last thing is gaming and social media. It's not something we would like to play with. And a lot of our ideological sense of what's good or bad for us to invest in goes through things we would like to use or have our kids use.
Yeah.
And I don't like my kids using social media. I don't like my kids doing gaming, so I would invest in that.
So in regards to raising your first fund, when you wanted to first start investing, I know that you mentioned in other conversations that you did not raise from the World Bank, the National Monetary Fund, et cetera. You focused on fund managers, and a lot of that was based off folks that you know and your network. But what was that experience like, raising your first fund? And how did you find your initial LPs?
Swing was really hard. I don't
Yeah.
recommend to anyone trying to do it. It still makes me feel creepy when I remember those days. So much rejection, right? So much wasted time. So we started doing that. We're starting approaching investors that we knew had invested in some sort of funds, not VC because there weren't any VC funds, but we had invested in private equity and had invested in real estate, which we thought were kind of something they wouldn't understand, right? So this is fund. It's the same fund structure, is different outcome or what we're focusing on. And slowly, so through this first context, we started to always try to go see one of them and try to walk away with one more name. So that's how we ended up. We probably started with a list of maybe 30, 40 people, and we ended up with a list of about 300. So it was really long. It took us we first started in January 2013. I'd say the first 6 months were not even approaching fund investors, was just trying to understand how a fund works, because we had zero experience in this and nobody wants to tell you what it's like, right? So there's very little communication in the market. It's just a really opaque ecosystem. So we tried to build, so we spoke with many, so especially US investors, advisors, you name it. And sort of out of that, we built what we thought would be a fund. So that took us probably between January and maybe August, September. So in September, we started contacting investors. We probably spoke with all of potential investors we knew within the first 6 months. None of them wanted to invest. There were a couple of investors that said, I will be an investor as long as you bring another one first. So nobody wants to give first. That was the first shock, like, yeah, but how am I going to get this guy to say yes if nobody wants to say yes before? Because nobody wants to be the first one. So we were in sort of a limbo like for 2 months where we tried to rekindle these conversations. And we ended up going back to one of the investors that said they would like to invest as long as there was someone else already on board. And we're very frank with them, saying, either you do the first check or there's not going to be a fund because there's nobody going to come in, right? So they said, okay, well, I'll do a big check as long as I get something in return, right? So we ended up sharing with them part of the carry of the fund. And we ended up giving them one seat in the investment committee. And that was very specific. There was one family member that we knew from before, who is an entrepreneur. So we knew the mindset was similar to ours. And it was going to be one bullet out of 3, right? So it was important that they're not going to control the investment committee. They're going to be able to see what we're investing in. And they might not like it, but they're going to be able to decide, which was, for us, the most important thing was keeping control of the decision-making for the investments, which was one thing that, we didn't get very far ever with the IDB or any of those multilateral agencies. But one thing that was very clear with them was that if they were ever going to invest, we're going to have a lot of control on the fund. And that's something we weren't willing to give to anyone.
And then when you were raising your first fund, which countries were your LPs from?
That's a very generous question on your part. Let alone a country, which city were they from, right? So 99% of our investors from Fund 1 are from Monterrey. You've both been to Mexico. I don't know if you've been to Monterrey. It's very different to Mexico City, right? Mexico City is more money that was made because of connections, either government contacts or business contacts, or it's, like the metropolis in all Europe, right? The money in Madrid, in London, it was made because of your connections, not because you were very entrepreneurial. Monterrey is a city that's the Israel of Mexico, right? It says that it was a desert, right? It was actually populated by a lot of Jewish expelled from Spain. So They actually were there not because they wanted to be there. And they're super entrepreneurial people, right? So I don't think there's a place in Mexico where meritocracy is more admired than Monterrey, right? So people really like taking a risk and getting their rewards for it. And I think that really resonated with them when we pitched our fund about what we tried to do. While with the Mexicans, it was more like, so what's my return? What's my guaranteed return? Like nothing like that. So that's why Monterrey was like the first place where we got some positive feedback. And it's also very connected because it's very entrepreneurial. It's very community driven. And so getting one investor from there dribbles to another investor and another investor. We ended up having 13 investors. Out of those 13 investors, 11 from Monterrey. Then the second fund, we opened it up a little bit more. We started having some international investors, no longer just Mexicans. We had some people from Europe. We had some people from South America. No US investors yet in that fund. And we had people from around the country. So we didn't only have people from Monterrey. We had people from Mexico City. We had people from Peru, from Brazil, from Germany. So we started amplifying it. And then the third fund, we finally got US investors. And that was super helpful, right? It's a very different mindset. It's a very different side, even from the family office side. The family office, the way a family office operates in the US is very different from my office in Mexico. It's much more professional. There's a lot less, I would say, input from the decision makers, from the family members. There is in Mexico, right? In Mexico still, it's professional, but you should have a lot of input from the family members. In the US, is very supervisory, right? Like they're more being kept abreast of what's going on than having to really make decisions.
Yeah, thank you. That's really good insight into kind of like the cultural differences with LPs in different countries, especially Mexico. So getting a little bit more macro in terms of how LP bases have developed, do you think that similar to Wollef and how you just mentioned, like your LP bases developed like over subsequent funds, do you think that's like a kind of a typical track for VCs in Latin America? And then also expanding on that, just thinking about in general over the past, 10 years, how have LP bases expanded? Who were the typical LPs? Who are they now? Is it kind of similar in Latin America? Is it like similar people that are investing in VC funds, or does it look a little bit different?
So I would have said beforehand that most funds in Latin America are like ours, that have almost all the money for family offices. I was surprised to find out that's not the case. And most funds in Mexico, in Latin America, have a lot of multilateral money, right? IFC, IDB, CAF, those kind of things. They have government money from the local governments, and they have some pension funds, right? And a little bit of family office money. So the family office money is more like a rounding up thing than really the main core. Right? In our case, it was the main core. And I think what we've been able to build through these three funds is build up our LP base, where that LP base can sustain us for several funds going forward. We might be able to, maybe bring in 5, 10 new LPs, but it's probably going to be the same base overall. I think it's very different from Brazil. For example, Brazil, I think you have a lot of other investors that are not family offices. You have pension funds, you have insurance companies, you have all different kind of players, more like the US perhaps, endowments even. I think the other countries are much, much smaller than Mexico. So I think the only comparable would be Brazil. Because if you go to Argentina, it's almost all of it's just family office money, and even more headed with individuals than actually family offices. Chile is a weird thing because historically, most of the funds were funded by the government through their Cornfo initiative. But that hasn't been a great return for those. But because also Cornfo was partly funded from private investors, right? So it has sort of become a bad name in Chile, but you're funded by Cornfo. So the new funds have either been funded by family offices or trying to find money from other multilaterals like the IDB and those. So I think that's changing. Colombia is a mystery because there's no VCs in Colombia. So who knows how they get funded.
Yeah, but there's plenty of startups. Like I think their startup scene is flourishing. It's kind of interesting.
Yeah, absolutely. But yeah, if you talk to founders in Colombia, they're going to tell you that their money comes from angels or some family members from big family, right? But rarely would you see a family office invest as an asset class on that. And there's no VCs, right? So it's either individuals, angels, entrepreneurs, or some family office member.
Actually, that's a good point. I remember talking to a couple folks about how to get more angels invested or interested in investing in Latin America. What do you think has been holding angels back? Is it just primarily, is it angels in Latin America that there just haven't been enough exits to have angels in Latin America?
So it depends on what you think of an angel, right? So part of it is what you said, there's not enough exits to have a mass of angels.
Yeah.
But I think more than anything is lack of education on what an angel actually is, right? Because most angels you will see, they make one investment every 2 years, and they believe they're an angel. As you may have seen, real angels have a budget every year, and they're going to invest X amount of checks every year, and they do that repeatedly and learn from those companies, learn from those investments, and just recycle them.
Yeah.
Here, I've only met, I'd say, 2 real angels that, even though they don't come from technology backgrounds, they are very clear about what they're. So they have, let's say, always are $50,000. So I'm going to make 2 or 3 tickets every year, and I'm going to help those companies very in deep. And they're very hands-on.
Yeah.
Most angels you see in Latin America are super hands-off, right? Like sparrows, but I mean super hands-off. Like they won't even look at a report, right? So I think there's a lot of lack of education on what an angel should do or how this actually works, because all things also, because they don't do this as building a portfolio, they make 1 or 2 investments, obviously both blunder, and it's, oh, this is work, right? So not angel anymore. So that's a big part of it.
So are there any specific market trends or opportunities that US-based investors or even angels might be overlooking in Latin America?
So I think it goes a little bit sideways from what you're saying, in the sense that it's not what trends they should be investing in, it's how they should be approaching the market, right? During the 2020-2022 bonanza, right, we saw a lot of US investors that felt like they had to be Latin American, right? But I don't know if it was arrogance or what. They came in and they invested probably checks that were 100 by size with maybe 1,000 of the due diligence I do. So they basically said, oh, I know everything, so I'm just going to invest wherever I want. I think all of those are going to be awful investments, all of them. And I don't see a single one making any money. Right? Well, you have other methodical investors. I think the best example for me is always QED, and it's the one we have the most co-investments with. QED has been super thorough on how they approach Latin America. I imagine the same thing with Africa or Asia, where they also invest, or Europe, right? But they've always been very wary about not having boots on the ground. So they don't have one. They don't have people. They have someone in Brazil, but they have one in Mexico, for example. But they've always been very close funds that they respect in the region. So they will always speak with funds like ourselves and ask us, like, this is what we're looking at. What do you think? Or what are you looking at? Or this company have doubts about, have heard of them? So they're always referencing local investors, right? And I think that speaks a lot about humility, about, knowing that you might be the case of the world, but if you don't know Latin America, you're going to have a lot of heartaches. And I think that's the way to do it, right? If I was running a firm in New York and I want to invest in Latin America, I would start going to Latin America once every quarter, meet people, get to know them, start sharing deal flow again. Because as you know, there's a big lack of capital in Latin America. So you start tomorrow La Frontera Ventures, you probably get 99% of every business plan that there's out there, right? Because they're just looking for capital. There's not enough. So yeah. I think it speaks to arrogance, thinking that just because you got a deck is because you're a good investor. I think you really need to get some flavor of what's going on the ground to really be able to make something successful.
Yeah, that makes a lot of sense. So what kind of experience have you had then co-investing with international investors? You said some will approach you and obviously respect your opinion and expertise in the region. What has that experience kind of been like for you?
So I'd say that probably we have 44 investments. We probably have foreign investors in maybe 38 of those. Right? So the majority of them. And in Latin America, it's probably the other way around. It's much easier to get allocation if you're a foreign investor than you're local. And the reason for that is that most founders don't want any local investors. They don't see what's the value in it. They don't see, they know your check is not as big as a foreign check. So most of the times you'll see that companies have at most 1 or 2 local investors, not more than that. Because they're actually focusing on the foreign investors. So a lot of companies we invested in, we have to really fight for allocation and convincing them that they need a local investor. So in that sense, it's part of, I think, why some foreign investors might think like, oh yeah, I can bring this investors because they're looking for me, right? Like they really want me to come in, but you have to cover the whole picture. So I'd say that, yeah, I mean, working with foreign investors a lot of times is just trying to bring down their expectations in the sense that sometimes they just do like a rule of 3, right? To think how big something could be in Latin America. And it's not as easy as that, right? Because of regulatory things, because of market, because of income, a lot of things. So really trying to translate to them what we see in the opportunity is really important. Sometimes they don't like it. Right? They think that we're just blowing hot air, but it's better to say something bad now than 20 years later.
And then speaking generally, how do, I guess, these portfolio companies get connected to international investors? Like, are you making the intros, like maybe in a later round, or are they reaching out directly?
So I'm typically very open to making introductions, even if we're not investors in the company. So when a company pitches to us and we decide not to invest or we're taking our time, I always offer them to introduce them to other funds, both Latin American and foreign. I think that's one source. I think another source is through startup founders that they know. So they will, which is, a big thing about VC compared to real estate or infrastructure or energy or any of the other asset classes is that there's such stickiness on returns from funds, because once you sort of have a reputation, it's very hard to break down in your preference, right? In the sense that, for example, let's take Confio, right? We invested in Confio. Confio makes a big exit. New founders come into the fintech ecosystem. They want to be like Confio. They're going to go look for the Confio guys that we invested in you. So they're going to send them our way. So it starts to be it's up to us to really screw it up. I think that the biggest example I have that in the US is Kleiner Perkins, right? It was the biggest business fund in the US, and it's not existent nowadays. And so part of it was hubris, right? Start believing that you can be a kingmaker. And that's something that never going to happen in VC, right? The founders are the start of the show, not us. And they're good with or without us. I think Kleiner Perkins was one of those things where they picked companies that might be a bit contrarian just because they thought they could turn them around. I would say the growth in assets, right? It's obviously easier to return $100 million than return $2 billion. And then the third thing is a transition from partners, right? So it was super reliant on Tom Perkins and I don't know, the Kleiner guy. And they never created the next generation of founders, of managers. As you would see in Sequoia, right? Sequoia has gone through 3 or 4 generations of great VCs. That never happened in Kleiner Perkins. So I think in Latin America, we're at that stage where there's a clear 2, 3, 4 top funds that have sort of things, and you have the rest, right? So I think a really important part is not believing that we ourselves are great, but that we have this opportunity to invest in great founders, right? And that's how we can help them.
Mm-hmm. Yeah, that's a great way of looking at it.
Yeah.
And then honing in a little bit on Mexico City, we saw you there pretty recently. We were there this summer and saw just kind of a lot of energy in the startup ecosystem, a lot of momentum, opportunities. But we're also aware that there's definitely some challenges specific to Mexico, and I think you'll probably have some opinion on this. So what's your take on the present and future venture investing in Mexico, startup ecosystem? You can talk anything from politics here on the new administration to just I'll let you do talk about what you want here.
It's a good question there, because the previous administration, the 2012-2018 administration, was super pro VC.
Right.
They created a fund of funds, all that. It didn't help at all, right? That was zero help. They went to the other extreme with the new administration in 2018, where they're completely against capitalism, right? So they hate funds and they hate everything. It didn't hurt either, right? And I think the reason for that is when you look at countries that are a bit farther ahead in the VC story or startup story, like Brazil or Argentina. Argentina doesn't have a great VC ecosystem, but it has a great startup ecosystem. Brazil, you have both. And you look at them, and they're super turbulent countries, much more than Mexico, right? Politically wise, economically wise, the fluctuations in inflation rates, in currency exchange rates, everything's super, super volatile. And you see that even in spite of that, you've had great companies, great exits in the last 15 years. So that would make you think that Mexico, as fast or as low as the case or whatever happens with the new administration, still going to have a lot of opportunities, right? So I think that's not a worry. And I think that's a typical developed world worry, not something for us, in the sense that, when we talk with some, especially European investors, they're worried about both exchange rates and volatility, right? And if you're worried about that, I think you should never be investing in Latin American VC. Like, it's going to be a terrible time for you. And what we've seen is that the cycles of investors are so long that they just sort of eat into those worries, right? Because, in a 10-year cycle, you're going to see a lot of evaluations, you're going to see a lot of that. But at the end, it should come on top. And that's what we've seen. For example, Mercado Libre, that's always the biggest example. Mercado Libre started in 1999 in Argentina. Argentina has devalued itself, I think it's like 99.6%. So the idea, they went from 1 peso to $1 to 1,200 pesos for $1 nowadays. So that's a big value. In every year since 1999, Mercado Libre has grown in dollar terms in their country, right? Which that gives you that how much actual volatility you can absorb just because the digital economy is so small within the whole economy that it has so much room to grow that, if any e-commerce says that they're doing well because of the economy, I think they're bullshitting. There's no way that they could be affected by the macro.
That's great insight. Thank you. One thing we're kind of curious about as well, and we know that you mentioned nowadays you primarily get inbound for investment opportunities, correct? Given that your first fund was about 2014, about 10 years ago, how did you source potential investments back then, and how has that evolved over time?
So that's how we first got encouraged about doing this. My partner and I had done a lot of, I don't know, maybe 3 or 4 angel investments, right? In a period of maybe a year and a half. And we both had exits, right? Him with Mercado Libre, me with another company. And people assumed that we had a lot of money. So people started looking for us, I'd say word of mouth, and towards coming to us. And we wanted to invest in a lot of them. We didn't have the money. And that was the idea of why should do a fund, because we don't have enough money for the opportunities out there. And we did see that even though we were one of many people that I spoke with, the founders, we did think that we resonated more with those founders than people that didn't come from this. So that's why we decided to fund. But yeah, I'd say that if there's any investor in Latin America that tells you that they have a proprietary deal flow, just run away because they're bullshitting. Like nobody has the proprietary deal flow. I think there's some things that you might see earlier than others, but in the end, it's very rare that you won't see it. So I think looking at deal flow is not a difficult thing. I think getting allocation to good companies, that's a really hard part. And that's where all this reputational sort of snowball effect comes into, right? Because, they know that you've done well in the past. They know you've been good to founders in the past, so they want to talk to you. And they will give you an allocation, you get a chance. So to this day, and I knock on wood, we have been able to invest in every company we wanted to, right? Even when there have been super competitive rounds. And I think that's the case is just because it's reinforcing, right? Like, for example, I had an earlier call today with a Chilean fund. And the guy was really surprised, saying that I heard that with you, every first meeting is with one of the partners. But like, yeah, obviously, like I would assume that's no. For us, it has to be like 2 or 3 meetings where we build a case and then we present to the partners, and then the person said they want to speak with the founder. I was like, how can you work like that? What did they do the rest of the day? Right? For us, it's like our 24-hour business is doing this. Right? We're not doing anything else. So I don't understand what a partner would be doing if they're not looking at the founders.
So something I was curious about as well, when you were doing angel investments at first, did you end up tracking MOIC on your angel investments as you were getting ready to start your first fund?
They were super early. So, I think that the investment that had the most time had maybe a year. There was no MOIC. Right? And also, I think part of what you're talking about, the cycles in Latin America, when we started investing, I would divide it into 3 cycles so far. Right? The first one was 2010, 2017, which was super early, right? Like there were maybe a handful of funds across the region at most. Yeah. And funds above 50 million, there were maybe 1, which was Kazakh. I don't think there was another one. Then 2018, 2022, that was a whole, starting of the bubble on the whole bubble thing. And that just a lot of funds, a lot of money, a lot of over $50 million funds, which for Mexico, for Latin America is great. It's really big. And then post-2022, which you've seen a lot of debt funds, right? Or zombie funds, where they have money, they don't want to invest it because that would mean they would need to raise a new fund, and they're not sure they can do it. So you have a lot of these funds that are, just looking at things and not doing anything. So I think in those 3 cycles has been very different both the willingness of founders to get long-term investors and the attractiveness of the market for foreigners. I think the first part was non-existent. In the second part, it was existent for the wrong reasons. And I think now we have a refining where you have the funds that really want to do this for the good reasons.
Yeah. So do you guys have a playbook for when you're investing? So for example, we know that there's like a YC batch model where they take a couple companies at a time, evaluated them, and then invested in the top performing companies that they would look at. Or there's some funds that are more of like a rolling funds. They have a certain amount of tickets that they can write, and they just write them as they go along over the next few years after they raise the fund. How do you guys go about investing? Do you guys batch the evaluation of your investment opportunities and then invest in a few at a time?
No.
Okay.
It's super on certain rolling basis, right? So
yeah,
everything that comes in, we look at it with the idea of making a decision as soon as possible. We really are worried about wasting time for the founders. So the first signal we see that it's a no, we'll let the founder know.
Yeah.
We'll be at the first meeting, we'll get the first analysis, the second meeting, whatever. But we really try to get that out of the way as soon as possible. We don't have any hurry on investing the fund. We have a 5-year investment period. If all the investments are made on month 11 of the 5th year, we're fine with it. We don't care about it. Which is a problem because our family office LP base, they don't have a lot of VC asset class investments, right? So they don't understand what you don't call capital, right? Like, hey, it's been 6 months I haven't called capital. What are you doing? I haven't seen anything that's worthwhile. Yeah, we should be investing. Says who, right? And I think that's something that you see on Latin American updates in the US, where a lot of funds are capital allocators and not really investors, in the sense that they have a very strict guideline of when they need to raise funds and when they need to deploy funds. So they just deploy funds as a matter of getting through that stage of the fund process, and not really because they're looking for great companies, right? I think a couple of times we've sort of got caught in the hoopla of hot things. None of them have ever worked out. None of them, right? So we do try to remember those things, and every investment we've done that's failed is because we didn't stick to the process. Yeah. So I think the process is super important. I think it's ever evolving. I don't think we have the right process now that it's probably going to be better tomorrow. But as soon as we deviate from the process, you can look at a company and know it's not going to do well.
Yeah. So we'll dive a little bit more into the process, but what are some of the red flags for you that immediately you're just like, yeah, no, we're not investing?
So the first one is when someone talks to you in the first session about their exit strategy. Right? None of the founders we invested in that have done well were interested as their sole priority on doing well. They knew that if things worked out, they were going to make a lot of money, but that was not the first priority. Right? The first priority was executing their dream, and they knew that execution was going to bring a lot of money. So any time that a founder starts thinking about numbers and exits, and it's like, no, this guy has his mind on another thing, he might be successful, right? But it's probably going to be at a very tapped outcome for us. So we want to think about a sky with no limits, right? Because if they're having limits already, it's probably going to be even lower than that. Yeah. So that's a big red flag, right? Another thing is, I don't know if it's a red flag, but we don't really like founders that are sort of helicopter founders, where they're based in Miami or anywhere cozy, right? Cancun, and their market is in Mexico City. We really like founders that are in the battleground, but they're really getting the punches and seeing the client face to face and being part of it. I think it's very easy to do things from your penthouse in Miami and say things, oh, they were in Mexico. So we really like that to be, and you see a lot of that with foreign founders. You see people coming from the US, Canada, UK, France, Germany, first world countries with first world jobs, working in investment banking, working in consulting, working in top corporations. And they vote with their feet and move to Mexico to start a company. So I think it speaks a lot of them taking that risk, right? Coming to a different culture, a different style, lifestyle, and taking that risk for us to put our money into it. Right? Yeah. I think they have really voted with their lives. So why should I say no? Right? Which is the opposite with a lot of Latin Americans, right? Like I said, I'm living in Austin and have this business motto. So good for you, but not for me, right?
Yeah, so really finding the folks that are in love with the problem, not just the idea of starting that business.
Yep. And then once you do make that decision to invest, what do you see your role as in fostering that company's growth? Like you talk about a lot, helping startups out, helping the ecosystem, helping the founder, and you help them with sourcing potential investments. What are some other ways that you support companies specifically?
So our North Light is think about getting out of the way, right? That's our main thing. So we're always thinking about whether we're taking away attention of the founders for doing something that they should be doing, or we're actually going to be able to help them with something. So our first idea is don't subtract value, right? If we do that, we're probably about 90% of the funds out there. So there's three things I think we can be helpful with. One is recruiting, really building teams. I think that's something we really spend a lot of time in. I think fundraising, as I said, something I personally like a lot, speaking with funds and telling them about these companies. I never try to sell the companies to them because I don't think that's my role, but I do make it interesting enough that they want to speak with the founder, right? I think the founder is the one that has to really make a sale. And the third thing is, getting in touch with suppliers, getting in touch with clients, that sort of thing. Those three things we can do, but we're never going to push, right? We always try to think about investing as grandparents. I don't know if you've heard of this, but it's very different to be a parent to be a grandparent, right? If you're a parent, you have the authority. And I can tell you, go to sleep at 8 p.m., eat breakfast, clean your room, whatever you want. Grandparents, they don't have an authority. And they don't want to lose that relationship with their grandkids. So they're more about giving advice, and the grandchild knows if they're going to follow it or not. But the grandparents picks out of experience, right? So it's like, when I was your age, I wouldn't drink that much. Well, if you want to do it, know the consequences are going to be this, right? And that's how we try to approach it. Like, I wouldn't do that. And this is why I wouldn't do it. And I hope that you can listen to me and make an informed decision. But the decision is yours, right? It's not me. It's not my doing it. So I think that's something that we really take a lot of care of. And we always try to think about that advice coming in line of the best thing for the company, not for us or for the founders. And I think that's something that founders really respect, that we don't optimize for ourselves or for them. We optimize for the company. We think that if we optimize for the company, in the end, we're all going to do well. Right? But if we optimize for ourselves, at some point, we're going to be just called, hypocrites, because we're truly living for our own agenda, not for the company.
Right. Yeah. And that makes total sense. I mean, you trusted this company, right, by investing in them. Like you trust the team to make the right decision. So getting out of their way, like, with, watching over them and providing some mentorship and guidance, that makes a ton of sense. And another thing that we really wanted to talk about, that you mentioned this word a couple of times, exits, right? So one of the things that we've heard from other VCs in the region in Latin America is that there haven't been a ton of exits, and it's just a very difficult environment, especially now. Maybe that's one of the things that's holding maturity in the VC industry in Latin America back, is just the lack of these like big exits that people talk about, read about. So can you talk about just your kind of view of the general exit strategy that you like to pursue? Obviously, like you talk about, you want, what's best for the company and grow the company and going forward. But like at the end of the day, like you do have to return money to your investors, right? So maybe talking about some success stories in your company with your firm, and how you navigate returning money to the investors at the end of the day.
So I think it's still, the Latin American market is very young to be able to really know if it's good or bad exit wise, right? Like most funds you look at, they're probably completing their first cycle. So probably 3 or 4 years for really knowing if that first vintage of funds were good or not. It's clearly not as fast as in the US, right? There's not as much M&A as in the US. So in the US, it's not weird for a company to be sold for hundreds of millions of dollars at 2 years after they were founded. Right? That's impossible in Latin America. That doesn't exist. That being said, I think exits are happening at the pace you would expect for the amount of capital invested. Probably not as fast as people would like, but I think it's normal for the amount of capital being invested. I think this is somewhere where a lot of foreign investors have a big role, in the sense that the big pools of capital aren't here, right? big pools of capital are outside. Those pools of capital have to be interested in this market. And I think that happens more or less now that they see that very big businesses were built in Latin America with traditional companies, right? Procter & Gamble, PepsiCo, American Express, they have huge franchises in Latin America. So there's a big market to make a business here. And you see now that happening with Uber, Netflix, Spotify. For all of those companies, one of the top 5 markets is Latin America, easily. Brazil or Mexico or even Santiago. So you see that there's big businesses. You see that some companies starting to do more M&A here. In our case, because we enter so early, most of our exits are not the final exit. Most of our exits are secondary sales to a bigger investor. I think, in general, that's the IP, and I think that's something that's trending in the right direction, but as most things, it just takes time, right? It's just going to take 10, 20 years to really get there. At the same time, I think a lot of the disappointment right now with exits in Latin America is more a fact of what's happening worldwide, right? Like you don't see exits anywhere else, right? It's not like Europe is booming or Asia. It's like there's no exits anywhere. Right? Probably here it's more obvious because there hasn't been a history of exits. But I just think that the good companies that continue to build businesses, at some point they're going to be acquired, they're going to be able to do a liquidity event. Most of those liquidity events that are not transactions are going to have to be IPOs in the US because there's just not local markets for doing that. Even, for example, Nubank, right? Nubank, when they listed in the US, they did a small listing in Brazil. After a year and a half, they delisted from Brazil because there was no liquidity. So we don't have capital markets that are deep enough for tech. So I think we're over-reliant on outside capital for that, whether it be on IPOs or permanent transactions.
And then can you talk about how you approach like secondary sales and those types of exits? How do you come to the decision to do that, and when is the right time?
So more than the timing, I think it's about the outcome, right? So we will analyze every secondary offer we get, but we always look at it in view of what's the multiple we're getting from that transaction and what's the life cycle of the fund. You will see that most of the offers for companies are for companies that you don't want to sell yet. Right? Obviously, the ones that are not doing well, they're not getting any offers. And it's a hard thing knowing how much to sell when. The only company we've exited fully is Nubank because of the IPO. But the other companies we've done partial sales. And that's another thing that I think wasn't apparent to most of our investors, but now they really like about having invested in VC, is that we're uncorrelated with the market. Most of our exits have come at moments when the market wasn't great. Like, for example, during COVID, we did a partial exit. When everything came down in late 2022, we had a partial exit. So there's always been this capital being returned to them. And they're like, oh, that's nice. I didn't expect that because my public portfolio is doing terrible. So yeah, I'd say we haven't had the opportunity of this happening, but I don't think you can sell a company. I think companies always bought. Right? It's more of a passive thing where someone can come with a good offer. I think if you try to sell it, you're probably going to have to sell it for a loss. And, we're not yet at that point. Like I said, we're still in the early part of this life cycle. Our fund still has 2 years to go. So maybe in 2 years, I can tell you better how bad it is.
Thanks for that.
No, that's great. That answered my question. I was wondering if you guys were actively shopping these secondary sales or they were more inbound.
No,
but,
I don't.
Yeah. One thing also I was kind of curious about. So a lot of the issues that we've heard about some of these startups with larger valuations is the larger the valuation, the less the chance of exiting via M&A. Just like you mentioned, there's a lot of companies that don't just have the capital to make those huge acquisitions in Latin America. So what's the strategy there if like an IPO doesn't seem like feasible and a startup is getting larger? Do you guys advise startups that once they reach a certain valuation to start looking at potential M&A exit opportunities, or just continue to grow as fast and as large as possible and then potentially eye an IPO in the United States?
So I think there's like a breaking point above which it's almost impossible to do an M&A transaction here. Right? I think probably anything that's worth more than 500 million is very hard to sell in Latin America, right? Most M&A transactions in Latin America are in the hundreds of millions at most. Right? There's not $1 billion transactions. So I think and you have this sort of gap where if you're above 500 million valuation, but under 5 billion in the US, you're probably not IPO, right? So you have to really cross that gap really fast. So that's a big chasm, right? And I think that's a hard part. Some companies that I started to worry at companies that are not at the $1 billion stage, but they're above 500 million, because I know that they're in this tricky part where there is no market for them. So you really have to run fast. Our advice is always to build businesses that are business in themselves, right? And not something that's attractive to someone. I think one example of one company we didn't invest in, and I think we didn't invest for the right reasons, we would have been a great outcome, was Corner Shop. Yeah. So Corner Shop, from the beginning, they were very set on the idea they were never going to make money. There's just going to be such a nuisance to retailers that we're going to get bought by some of them. They were bought by Uber in over $1 billion valuation. That was very unlikely, right? When we get the investment. And also having a company that was not going to make money, and it took them maybe 5-6 years to exit. And there was not a clear amount of capital in Latin America to be able to sustain the losses for that long. So yeah, I think those are still, it's a playbook. It's more not common in the US. I think it's really hard in Latin America because of the lack of activity.
Do you think that going forward, there's going to be, I know that in the United States, a lot of startups have been focusing on just default survivability. So essentially just being profitable from the get-go. And do you think that there's going to be some opportunities for, obviously, maybe not like revenue sharing, but some other types of structure for investment where essentially startups won't have to deal with that chasm where they're between like certain valuations, their only exit ops are essentially either M&A or IPO, and especially for the investors to maybe incentivize some more investors to invest in Latin America? Or do you think there's going to be?
I have no idea.
I don't know if you've ever thought about something like that, or
you think highly of me.
Yeah. I know in the United States, there's a lot of folks kind of focusing on like convertible debt and things like that for investing.
I mean, I think there's a lot of exotic things you can do with startups.
Yeah.
I think we're still so primary in our investment understanding that if someone can even understand the VC equity investment, as they're already about mezzanine debt, they're going to be like, what? So really, yeah. I think we're so far behind that it doesn't make any sense.
Got it. Thank you.
Thank you so much for your time. It was really great hearing about, I mean, I can see your values and love for what you do really seeps into the work, and it turns into results. And also thank you for being always so open to chat with young people like us who are really interested in this space.
My pleasure.
Yeah, this has been awesome. Very enlightening.
Yeah.
My pleasure. Anything you need, please let me know.
Perfect. Thanks so much, Cristobal.
Thank you for tuning in to another episode of La Frontera. We hope you enjoyed the show. You can listen to more great conversations on our Spotify, as well as on your other favorite streaming platforms. You can find us online at lafronterapodcast.com, and make sure to subscribe to our newsletter for show notes and to stay in the loop for new content. Ciao for now.